Has U.S. inflation peaked? And is stagflation headed here? Hopefully, our chief equity strategist and economist, John Blank, has some answers. John, recently published survey data by a major bank showed about 60% of global investors think U.S. stagflation could be the dominant global market regime within 3 months. But there are consumers here that are still spending. Data here so far showing progress being made on inflation. And in light of that, how probable is stagflation for our economy?
Terry, I think we're in stagflation. I'll tell you why. Last year we had a 2.8% real GDP growth rate for 2024, and this year the latest survey, and I read it yesterday, was 1.6%. So we've already lost 1.2% in the growth rate for the U.S. economy, and we're speaking on August the 28th. As far as prices go, um, they're certainly sideways and well above the Fed's mandate before the tariff story. I mean, we're looking at 2.6, 2.7, 2.8 on the core PCE rate, and that is well above the 2% rate. So the Fed, even under no tariff scenarios, has to be restrictive in the face of that mandate. And then we added a 0.4%, 0.5% addition to that to a 3.2 by the end of the year on the tariffing. And you can say that's not going to happen, but these macro models, Terry, when you have an 18.6% tariff, widespread tariff rate, that is actually very easy for a macro model to be inputted and addressed in terms of all the feedbacks and the levels and stuff. So unless you're gerrymandering the results, Terry, that 0.4, 0.5% addition to the core PCE rate should be taken very seriously because it is a widespread effect and they can model this pretty accurately.
All right, so if stagflation has already set in, what would have to happen for it to become more apparent to the average consumer?
Christmas season, Terry. I think when people go into Walmart and Target and these groups for their shopping, Best Buy, and they look at the shock of having a 15 or 20% additional price on things they're buying, that's when we'll know. And we'll know from a lot of sources across the big box retail space what has happened relatively quickly. Not quickly, not September, October, but by Halloween and after, we're going to definitely know.
Big story is going to be told tomorrow when the Fed's preferred inflation gauge, the July core PCE inflation print, comes out, and that'll be on August the 29th because we're talking here on the 28th. Do you see that data supporting investor hopes for an interest rate cut next month, especially in light of Powell's Jackson Hole speech last week?
No, I don't think core PC is going to help Powell one bit, like we just spoke to. What's going to help Powell and what Powell spoke to at Jackson Hole was a weak employment mandate. The thing that came to a Fed rate cut is the Fed's other mandate of full employment is the one they focus on and they get enough votes for, and that gets the rate cut.
So, is this next PCE report combined with a rate cut, if one happens next month, going to affect the bull bear story on the U.S. economy?
Well, the bull story is a valuation expansion on the AI story. It's a narrative driven tech market, basically. And the bear story is what I told you that there is literally no growth away from government finance areas of healthcare and teaching and stuff like that in the U.S. economy. Just for example, Terry, the California economy, where Silicon Valley is based and where the AI narrative is playing out in a dramatic way, we have a 5.5% household unemployment rate in California, and the nationwide one is 4.2%. So if it's going to turn out to be just such an incredible AI event, why do we have 1.3% more unemployment than the rest of the country on average?
Yeah, it's a good question. What about the bond market? Is that sending any concerning economic signals?
Not yet, Terry. The bond market is in a stupor because, again, the big, beautiful bill has been passed, but the effects won't be felt. Tax effects until April next year, and Medicare cuts are after the election for the most part. So that's got a lot of media hype, but no real pressure on the bond market. And people are for some momentum trading reason, the narrative reason we talked to, have not focused on the attack on the Fed, and there's this sanguine view that that's going to play out fine, which might be right view, Derry. It might be the right view, but it is a really unprecedented thing to attack the Federal Reserve's independence. In my lifetime, it hasn't happened, and we've had it happen without any effect. And that's kind of spooky, Terry, to be that complacent.
So, what else is on your wall of worry regarding the economy?
Terry, I fundamentally worry most about what happens to small and mid-sized businesses and the tariffing because they are the least able to work around issues with tariffs on their core products and the most likely to start firing people. And the way you get into the big cycle down from here is people get fired, and we need to watch out for what happens in small and mid-sized businesses this fall.
What about the global economy? What's the story there?
Jerry, I'll point out that the Mexican economy for 2025 is, in the latest data I read a couple days ago, is 0.1% growth for the Mexican economy. There's 14.6% youth unemployment in Canada. So, the attack on our neighbors, even though they have, trade agreements with us that circumvented a lot of the tariffing, is material. Issues in Japan. Japan never does more than a 1% growth rate generally. So if you attack their from the tariffing perspective, going from 1 to 0 is not too hard. So we got to watch out for Japan, what happens there in the bond market. So really, it's friendly fire. It's people that have done business with the United States and have agreements with the United States, and we're buying our exports to the United States. They're probably more concerning than China, Terry.
You wrote recently that American economist Hyman Minsky is most directly and comprehensively associated with a theory explaining how financial markets inherently create their own instability and lead to bubbles and crises. So, based on his theory, do you see any bubbles in the markets or the economy right now?
Yeah, so basically, what Hyman Minsky points out that finance starts out financing stuff, physical stuff, plants, property, and equipment, and that's the early cycle of a boom. You get an info tech boom, and people really did build actual stuff in the early days. They built companies like Amazon, they built companies like Microsoft, and so on. And then what happens over the cycle is the underlying finance of everything gets more and more aggressive, more and more speculative, and ultimately it just becomes money trading for money with no physical activity. And that, in many ways, Terry, is exactly what Bitcoin is. It's just money trading for money. There's no tie or basis into the physical economy anymore. And so this is what Minsky called endogenous financial instability, which means as the cycle progresses, it naturally creates more financial aggression and speculation, and that naturally creates the potential for a crisis. And we're here, Terry. We've been printing money and doing crazy stuff since 2009, and it's 2025. That's 16 years, and that's a long cycle other than COVID. And the thing about COVID is we just did more money printing to get out of that. And when does the music stop, Terry? That's the issue you got to hear, and that's really what Hyman Minsky is often alluded to, is that we are thinking everything's the same, and everything has been slowly but surely morphing into more unstable financial structures for some time now.
All right. Zach's number one ranked stocks you're watching include Watts Water Technologies, Armstrong World Industries, and Levi Strauss.
Yeah, Watts Water Technologies. Let's talk about this. This is for creating better water systems for people's homes and commercial uses and stuff like that. Uh, Forward PE ratio on industrial stock is 29. It traded at 180 or $90 a share in the Liberation Day tariffs. I've got $285 a share with a target price at 307. Super momentum trading run on this stock in the last 4 months. And yes, Terry, we have a value score of F on this stock. So really interesting business. But is all the good news priced in and then some? I would say so. Our chart shows it's pricing fairly highly out to 2027 now.
Okay. Armstrong World Industries.
Armstrong World Industries is a leading producer of ceiling systems and construction and renovation of commercial residential buildings. So this is basically ceiling systems, that we get in our houses and our businesses. And again, this stock has been on an incredible tear from 130 to close to 200 in the last 4 months. And again, the value score is F, and it's pricing in earnings out to 2027 once again. And again, this is just your standard building products name on a momentum run. That's not generally a good thing for saying there's not a bubble, Terry. Levi Strauss, of course, we all know this company. They design and market jeans, but they also do casual wear and accessories for men, women, and children. Really an old company out in California. And the shares are, reasonably priced at, $20 a share. Get a bounce from 14 to 20, but back in the COVID period, these were at $30 a share. So here you've got a value score of B, a growth score of B, and a Zacks ranking number one. So from short and long term perspective, today what we're talking about, Levi Strauss might be the play to look at.
Our chief equity strategist and economist, John Blank, on the economy and stagflation, among other things. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.